For more on the market, let's bring in Julian Emanuel, Senior Managing Director at Evercore ISI. Slipped in here on Snuck in. Julian, great to see you.
Great to be here.
You make the point that it's been a tough bull market. Everybody wants to find a reason to not believe this one. It's too good to be true. Why do you think that is?
Well, first of all, because when you think of this set of circumstances, right, you threw everything you had at the pandemic. Then you had, sort of a speculative top in SPACs and profitless tech in 2021. And then all of a sudden, the Fed was doing what we knew they had to do in response. And the speed with which they did it, here we are. We're still the economy that's the envy of the world. And you're actually now at a point where at 24 times trailing, you're very, very expensive. That's probably why you saw that note this morning from our competitor. But what we would say to that is tells us the wall of worry is still very, very intact. And I mean, if you think about it, yeah, the VIX is low compared to maybe longer run history. But actually, if you think about the inertia of the markets the last several weeks, the VIX is high, and it should be in front of probably one of the biggest unknowns we've been facing, certainly in the last 4 years, if not longer.
Carter is quick and correct to point out that we've seen 4.2% in 10-year a number of different times, both up and down. But the move from 3.6 to here has been fast. We spent 8 minutes trying to figure out what it's about. What do you think it's about?
I think a lot of the people that we talk to are surprised because basically the thought was the move by the Fed to cut 50 basis points should underwrite the long end. And in fact, when you're doing that and the economy is not going into recession in the next several quarters, when, as you mentioned earlier, both candidates are going to blow out the budget deficit. And now, in the last few weeks, there's a potential that China could at least stop exporting disinflation. That's what you get in the long end.
Julian, we're going into the year end. We have an election year cycle, so there's a lot of movements that none of us are going to be able to describe the reason for them. You have new money to put to work. Do you just go with technology at this point? I believe in fragmenting it out with crypto, emerging markets, technology, not making it as complicated as it used to be. Where do you put the money right now going forward?
So as equity strategists, we'll give you the equity strategy point of view. We love what we call the Fed rate cut playbook, basically. You go back to 1970, you look at all the rate cutting cycles, there's a very pronounced outperformance in the year after the Fed starts cutting from infotech, surprise, surprise, small caps, which might be a bit counterintuitive considering how much they took it on the chin today, but also barbelled by the more defensive sectors, consumer staples and healthcare. So to us, that's sort of the sensible way that will help you ride out if you get some turbulence, which, of course, if there's a contested outcome, you're likely going to get some turbulence.
Is there concern that information technology outperformed on the way into the cutting cycle and so may have pulled forward gains? I mean, in past cycles, did we see this sort of outperformance as well?
We did. Again, a lot of that owes to the secular gains over the last, call it 40 years in infotech. But again, it also calls up this point, Melissa, at 24 times trailing. If we get a quote unquote clean outcome in the election that everyone says, OK, this is what happened, and we get a melt up, which is very, very possible. That's the kind of situation where, particularly in infotech, you'll be borrowing from next year's gains. But I think, again, we have to acknowledge the fact that one of the very bright spots today is the leader in the AI revolution made another new all-time high. Very positive.